Options trading is a popular way to invest in the stock market. But what are options, and how do they work? Options trading is a type of financial derivative that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, within a specific time period. There are two types of options: call options and put options. A call option gives the holder the right to buy an underlying asset at the strike price within the specified time period. A put option gives the holder the right to sell an underlying asset at the strike price within the specified time period. When you trade options, you can either buy or sell them. Buying an option means that you pay a premium, the price of the option, to the seller in exchange for the right to buy or sell the underlying asset at the strike price, depending on the type of option. Selling an option means that you receive the premium from the buyer in exchange for taking on the obligation to sell or buy the underlying asset at the strike price if the buyer decides to exercise their option. The potential profit and loss of options trading can vary greatly depending on the price movement of the underlying asset. If the price of the underlying asset moves in the opposite direction, you may experience losses. However, if the price moves in the direction you predicted, you can profit from the trade. It is important to note that options trading can be complex and involves significant risks. It is recommended that traders have a good understanding of the underlying asset and options market before engaging in options trading. With a good understanding of options trading, you can potentially profit from the stock market while managing your risks. Options trading provides several potential benefits to traders, including flexibility, leverage, hedging, risk management, income generation, and customization. Here is a more detailed explanation of each benefit. Flexibility. Options can be used to trade different types of assets, including stocks, currencies, and commodities. They also provide a flexible way to trade in various market conditions, such as high or low volatility, bullish or bearish market conditions. Leverage. Options provide a high degree of leverage, meaning traders can control a larger amount of an asset with a smaller investment. This can amplify potential profits, but it also increases the risk of significant losses. Hedging. Options can be used to hedge against potential losses in other investments. Traders can either buy or write options to protect themselves against unexpected market events, which helps to reduce the overall risk of their portfolio. Risk management. Options provide a way to manage risk and limit potential losses by setting a cap on the amount that can be lost on a trade. This allows traders to take calculated risks while minimizing their exposure to potential losses. Income generation. Options can be used to generate income by selling options, which provides a regular stream of income from the premiums received. However, this strategy also involves significant risks, and traders must be prepared to fulfill their obligations in case the options they sold are exercised. Customization. Options trading can be customized to meet the individual needs and goals of traders. They can choose from different types of options, expiration dates, and strike prices to create a strategy that meets their specific needs. While options trading offers several benefits, it is important to remember that it is a complex financial instrument that carries significant risks. It is essential to have a thorough understanding of the market and the risks involved before engaging in options trading. Traders should educate themselves, develop a solid trading plan, and use risk management strategies to protect their investments. Options trading can be a highly risky endeavor, and it is important for traders to be aware of the following risks. Limited lifespan. Options have a limited lifespan and expire on a specific date. This means that if the underlying asset does not move in the anticipated direction before the option expires, it may become worthless, and the trader could lose the entire premium paid. High volatility. Options trading can be impacted by high volatility, which can cause the value of the option to fluctuate rapidly. This can make it difficult to predict the value of an option and can result in significant losses. Leverage. Options trading offers high leverage, which means that even a small movement in the underlying asset's price can result in significant gains or losses. This can magnify both potential profits and losses, and traders must be prepared to accept significant losses. Complex instruments. Options can be complex financial instruments, with a wide range of strike prices, expiration dates, and types. This complexity can make it difficult to understand and evaluate the risks involved, which can increase the likelihood of losses. Market risk. Options trading is affected by a variety of market factors, including interest rates, currency fluctuations, and political events. These factors can cause rapid changes in the value of options and can result in significant losses. It is important for traders to have a thorough understanding of the risks involved in options trading and to use sound risk management strategies to minimize potential losses. This may include setting stop-loss orders, using a diversified trading strategy, and only investing money that they can afford to lose. Traders should also educate themselves and seek professional advice before engaging in options trading. Options trading can benefit several types of individuals, including experienced traders. Experienced traders with a deep understanding of the market and its movements can benefit from options trading by using options to hedge their portfolio or by speculating on the direction of the market. They can use options to create a variety of strategies and generate profit from various market conditions. Investors. Options trading can benefit investors who want to protect their stock holdings from potential price drops by buying put options or selling covered call options. This allows investors to manage risk and generate income from their investments. Speculators. Speculators can benefit from options trading by taking positions in options contracts that allow them to profit from significant price movements in the underlying asset. This can provide opportunities for substantial gains, but it also involves a higher level of risk. Traders with limited capital. Options trading can benefit traders with limited capital, as the cost of buying an options contract is generally much lower than the cost of buying the underlying asset. This allows them to trade in a variety of assets and take advantage of market opportunities. Income investors. Income investors can benefit from options trading by selling covered call options on their stock holdings, which generates income in the form of option premiums. This strategy can provide a regular stream of income from their investments. However, it's important to note that options trading can be complex and carries significant risks. It is crucial for individuals to understand the risks and potential rewards before engaging in options trading. It is recommended that individuals consult with a financial advisor or do their own extensive research before trading options. Options are financial contracts that provide the buyer with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, on or before a specific date in the future. The underlying asset can be a stock, commodity, currency, or index. There are two main types of options: call options and put options. A call option gives the buyer the right to buy the underlying asset at the strike price, while a put option gives the buyer the right to sell the underlying asset at the strike price. In exchange for the right to buy or sell the underlying asset, the buyer of an option pays a premium to the seller. The seller of an option, also known as the option writer, is obligated to sell or buy the underlying asset at the strike price if the buyer decides to exercise their option. In exchange for taking on this obligation, the seller receives the premium paid by the buyer. Options can be used for a variety of purposes, including speculation, hedging, and generating income. For example, a trader may buy call options if they believe that the price of the underlying asset will rise, or they may buy put options if they think that the price will fall. Investors may use options to hedge their portfolios against potential losses, or they may sell covered call options to generate income from their holdings. An analogy for an options trade could be a real estate option contract, where a buyer pays a fee for the right, but not the obligation, to purchase a property at a specific price within a certain time frame. If the buyer decides to exercise their option, they are obligated to purchase the property at the agreed-upon price, while the seller is obligated to sell it. If the buyer does not exercise their option, the seller keeps the fee and is free to sell the property to someone else. However, options trading can be complex and carries risks, so it's important for individuals to thoroughly understand the risks and potential rewards before engaging in options trading. It's recommended that individuals consult with a financial advisor or do their own extensive research before trading options. Options are financial contracts that provide the buyer with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, on or before a specific date in the future. Options are commonly used in trading to speculate on the direction of an asset's price or to manage risk. There are two main types of options: call options and put options. A call option gives the buyer the right to buy the underlying asset at the strike price, while a put option gives the buyer the right to sell the underlying asset at the strike price. Call options are typically used when the buyer believes that the price of the underlying asset will rise in the future. Put options, on the other hand, are typically used when the buyer believes that the price of the underlying asset will fall in the future. There are several variations and combinations of call and put options, such as European and American options. European options can only be exercised on the expiration date, while American options can be exercised at any time before the expiration date. Exotic options are more complex and tailored to specific market conditions or trading strategies, and examples include barrier options, Asian options, and binary options. Call and put spreads are option strategies that involve buying one option and selling another option at a different strike price. Call spreads are used to limit potential losses while still benefiting from potential gains, while put spreads are used to limit potential losses while still benefiting from potential declines in the underlying asset. It's important to understand the various types of options and their characteristics, as each type of option has different risks and potential rewards. It's recommended that individuals consult with a financial advisor or do their own extensive research before trading options. Options have expiration dates, which means that they can only be exercised up until a certain point in time. The expiration date is specified in the options contract and can be weeks, months, or years in the future. Once an option expires, it becomes worthless. There are two types of options exercise styles: European exercise and American exercise. In a European-style options contract, the buyer of the option can only exercise it on the expiration date. In contrast, in an American-style options contract, the buyer of the option can exercise it at any time before the expiration date. When an option is exercised, it means that the buyer is using their right to buy or sell the underlying asset at the predetermined price, the strike price. If the option is not exercised, it simply expires and becomes worthless. When a call option is exercised, the buyer purchases the underlying asset at the strike price. The seller of the call option must sell the asset at the strike price, even if the market price of the asset is higher than the strike price. When a put option is exercised, the buyer sells the underlying asset at the strike price. The seller of the put option must purchase the asset at the strike price, even if the market price of the asset is lower than the strike price. It's important to note that not all options contracts are exercised. In fact, many options contracts are bought and sold purely for speculative purposes, with no intention of ever exercising the option. Additionally, some options contracts are settled in cash rather than by delivery of the underlying asset, depending on the terms of the contract. Understanding options expiration and exercise is important for options traders, as it can impact their trading strategies and potential profits or losses. It's recommended that individuals consult with a financial advisor or do their own extensive research before trading options. Option pricing is the process of determining the fair value of an option contract. The price of an option is based on the current price of the underlying asset, the strike price of the option, the time to expiration, and the volatility of the underlying asset. These factors determine the probability of the underlying asset reaching the strike price before the option expires, and the expected value of the option at expiration. Volatility is a measure of how much the price of the underlying asset, such as a stock, fluctuates over a certain period of time. It is a statistical measure of the dispersion of returns for the underlying asset. Higher volatility indicates that the price of the underlying asset is more likely to move significantly in price, making the option more valuable. Conversely, lower volatility indicates that the price of the underlying asset is less likely to move significantly in price, making the option less valuable. Option pricing models, such as the Black-Scholes model, take into account the volatility of the underlying asset as a key input to calculate the theoretical fair value of an option. The Black-Scholes model assumes that the underlying asset follows a log-normal distribution, and that volatility is constant over the life of the option. However, in reality, volatility can change over time, which is known as implied volatility. Traders and investors use implied volatility, which is derived from the market prices of options, to estimate the market's expectation of future volatility. Implied volatility is a key input in option pricing models, as it reflects the market's expectation of future price movements of the underlying asset. Higher implied volatility indicates that the market expects more price movement, while lower implied volatility indicates less expected price movement. In summary, option pricing and volatility are closely related, and the level of volatility of the underlying asset is an important factor in determining the price of an option. Option pricing models take into account the volatility of the underlying asset to determine the theoretical fair value of an option, while traders and investors use implied volatility to estimate the market's expectation of future volatility. Intrinsic value is the actual value of an asset, investment, or company based on its fundamental qualities, such as earnings, cash flow, assets, management quality, and industry trends. In other words, it is the perceived worth of an asset, based on its underlying intrinsic characteristics. For example, if a company has strong earnings, healthy cash flow, and valuable assets, then it is considered to have a high intrinsic value. In finance, intrinsic value is often used to evaluate stocks. The intrinsic value of a stock is calculated based on the company's financial statements and other factors such as industry trends, competition, and management quality. Investors use the intrinsic value to determine whether the stock is overvalued or undervalued. If the stock is trading at a price below its intrinsic value, then it is considered undervalued, and it may be a good investment opportunity. Extrinsic value, on the other hand, is the additional value of an asset that is not directly related to its intrinsic qualities. In finance, extrinsic value is often associated with options trading. Options are contracts that give the holder the right to buy or sell an underlying asset at a specified price within a certain time frame. The price of an option is made up of two components, intrinsic value and extrinsic value. Extrinsic value is also known as time value, and it represents the premium that an options buyer pays for the time remaining until the option expires. Extrinsic value is affected by various factors, including the time until expiration, implied volatility, and supply and demand. As an option approaches its expiration date, its extrinsic value decreases. Additionally, as the implied volatility of the underlying asset increases, the extrinsic value of the option also increases. In summary, intrinsic value and extrinsic value are two important concepts in finance and investing. Intrinsic value represents the inherent value of an asset or investment based on its fundamental characteristics, while extrinsic value represents the additional value of an asset that is not directly related to its intrinsic qualities. Extrinsic value is often associated with options trading, where it represents the premium that an options buyer pays for the time remaining until the option expires. A long call strategy is an options trading strategy where an investor purchases a call option with the expectation that the price of the underlying asset will rise in the future. The investor pays a premium to purchase the call option, which gives them the right to buy the underlying asset at a predetermined price, strike price, within a specified period of time. When an investor uses a long call strategy, they are essentially betting that the price of the underlying asset will increase above the strike price before the option expires. If the price of the asset does rise above the strike price, the investor can exercise their option to buy the asset at the lower strike price and then sell it in the market at the higher price, realizing a profit. For example, let's say an investor purchases a long call option for a stock with a strike price of $50 and a premium of $5. If the price of the stock rises to $60 before the option expires, the investor can exercise their option to buy the stock at the lower strike price of $50 and then sell it at the higher market price of $60, realizing a profit of $5 per share. However, if the price of the underlying asset does not rise above the strike price before the option expires, the investor may choose not to exercise their option and instead let it expire, losing the premium paid to purchase the option. Long call options can be used for a variety of investment strategies, including hedging against potential losses, generating income, or speculating on price movements. They can also be combined with other options strategies, such as a protective put, to manage risk and increase potential profits. It's important to note that long call options come with certain risks, including the potential loss of the entire premium paid to purchase the option if the price of the underlying asset does not rise above the strike price before the option expires. Additionally, the value of a long call option is affected by various factors, including the price of the underlying asset, the time remaining until expiration, and implied volatility. Therefore, investors who use a long call strategy should have a good understanding of options trading and be comfortable taking on the associated risks.